INR bonds. I'm Arjun Patsati. And in this edition of Bond Bytes, we will look at the new Bharat Bond ETF 2032 that is to be opened for subscription tomorrow. But before that, what's happening in the market? Government bond yields marginally higher as the bond market awaits RBI policy next week. The rupee is hovering around 70.75 to the dollar at its closer to weaker levels. While on the trade front, the trade data has come out for November and the trade deficit is up higher from October, while exports have fallen below USD 30 billion for November. We have seen exports cross $30 billion for many months now, and we need to check if this is a worrying sign, largely because there has been some countries that have closed the borders due to COVID, and there is still a lot of supply logistical issues itself, with a lot of blocks in the whole logistic processes and bottlenecks, and this could be hurting exports. So we would need to see what steps the government and trade bodies take to ease this bottleneck situation in the ports and other logistical routes. But let's get to the main topic today, which is the new Bharat Bond ETF 2032. And the Bharat Bond ETF has seen the past many Bharat Bond ETFs. We have seen the first launch of the 3-year bond, and then you have a 5-year, which was launched. They've all right now lower maturity. And then you had a 10-year bond that was launched last year. And then you have the new launch now, which is a 2032 bond. And this 2032 bond, a Bharat Bond ETF, is similar to all the other Bharat Bond ETFs in the sense that the ETF will invest in all AAA rated PSU bonds. And so this AAA rated PSU bonds, that means all government owned PSUs, top rated PSUs, clearly shows that the credit risk that is of the ETF is extremely low. You can say it's as good as any government kind of a risk, except that it's not direct government risk. And some of the bonds that could be invested in are bonds like IRFC, NTPC, and similar bonds, Power Grid, etc., which are the best PSUs and the most safest bonds to be invested in the bond market, given the ownership pattern and the support from the government. So in that sense, there is no credit risk involved. But having said that, clearly there is interest rate risk on the bond. So this particular 2032 bond will come at a yield of around where the PSU 10-year bonds are trading at. So it's on a blended yield should be around 6.87%, but it could be here and there as the fund invests the money once they collect it. But how should you look at it? One is obviously in that sense that the 10-year bond and the taxation is like any debt mutual fund. So if held for a period of 3 years plus, you get an indexation benefit. So it is a tax efficient, but then it doesn't provide any kind of a hedge against interest rates and inflation. So you would have to look at it in conjecture of what are the current other options available at around 6.87%. So let's take an example. For example, state development loans, SDLs. These are bonds issued by states. They are around similar levels. And that means the bond market is giving equal risk weight to state loans as well as PSU bonds. But having said that, states have more advantage in that RBI buys state SDLs in open market operations. Then there is the states have a direct support from the central government as well as RBI through overdraft facilities in case they need to make payments servicing the loans. So the risk profile of states are much higher than a PSU. But having said that, since the central government owned PSUs, then it can be safely assumed that the government will make sure that PSUs are the best credit risk always. But state loans definitely have more liquidity and are more well traded and have higher acceptability with banks and provident funds and insurance companies because of regulatory requirements. And so with that risk weight given to states and PSUs may be slightly maybe state we can say that the ETF is very finely priced. If you take government bonds, then at these levels, only the 15-year government bond and the 30 to 40-year government bonds are trading at these levels. The only thing going for the ETF at this point of time is the fact that it's more tax efficient over a 3-year period. Then you need to look at interest rate movements, expectations of interest rates over the next few couple of years. So we have had what are we looking at right now is the fact that with inflation expectations rising globally and in India as well, and with the economy doing better and with government finances looking good, the RBI may be in a position to start normalizing rates and start raising repo rates. What could be the impact of this? Supposing the 10-year government bond yield, Gsec yield, moves up from current levels of 6.35% to say 6.7, 6.8%, then even the Bharat Bond ETF yield will move up by similar margin. And when that yields, the price, that is the NAV, will fall if this happens. So these are all some considerations. Here, it's not please understand that it's not what I'm giving you is an understanding of the Bharat Bond ETF, not a recommendation to invest or not to invest in the ETF. So you have to have, if you're content, if you're very fine with having a 10-year bond at 6.87% with the safest, with providing very high safety and certainty of return, and you're not worried about in-between volatility, then it's a very good instrument to invest in. But otherwise, if you're comparing it to many other products in similar risk nature or in terms of outlook on interest rates, etc., then you might have to take your own decision. So that's about it. It's opening. Investors can invest in 2 ways. If you have a demat account and have a brokerage account with, for example, if you have a brokerage account, you can go to any of your online brokerage platforms and invest in the IPO, or you can invest in the fund directly. The best thing about Bharat Bond ETF is that expense ratio is very low, extremely low, in fact, and it's very, very, very good product in terms of the fact that expense ratio is very low. So there is a lot of positives that are going for the ETF. Obviously, some of the other considerations, like I explained, would have to be taken into account. So you can take definitely an investment decision based on what we have spoken. And we always remember that you can log on to Quick Invest platform, which is a retail platform for bonds, and where we provide information on all aspects of bonds, including Bharat Bond ETF. And if you're an advisor, etc., we have training programs as well to teach you how to look at all these structures. Thank you very much. In the description below, you will find the link to Quick Invest. And if you're not subscribed to our YouTube channel, please do so. Thank you.